Hello, our wonderful audience. Welcome to the Sense of Things. It's Ron and I once again on talking a little bit about what's going on in the world this week. Ron's going to have some stuff on really how you game plan for the next 6 months, years, all that. Although they seem like they run together, are not necessarily truly that way. I'm going to run through a little bit today on the price of gold, looking at the Treasury yield curve, and we'll also look at the 30-year fixed, which all things are responding weird to the interest rate drops that we've seen. So stay tuned. We'll be right back in just a second. Hey, everybody. Welcome to the Sense of Things. Ron and I are here. Ron, how you doing, buddy?
Morning, Jeff. Good to go. I don't know about you, similar climate. We went directly from summer to winter. We got no fall.
Really?
Yeah. It's been cold here in the mornings, my friend.
Yeah,
And being
we
a
are.
Northeast guy, I miss the fall, but we've had some fall temps every now and then, but it went from summer to winter.
We have had a very weird fall. We're still in like the mid 80s every day. So today was the first morning, except for one day at the beginning of November, that it was in the 50s starting off the day. So
Hey, listen, are we starting to sound like old codgers where all we talk about is the weather? Soon we're going to start talking about how many doctor appointments we have this week.
Yeah, exactly. And who died last week? Yeah.
Did you check the obituaries?
Hey, I do every day just to make sure I'm not there, and then everything else is
Exactly.
good the rest of the day. If I'm above
Exactly.
ground, life is good. And if I'm below ground, I don't really have any say in the matter. So,
No, you don't.
well, let's kick off. We don't really have any pop culture today, but why don't we kick off with your stuff, talking a little bit about staying invested?
Listen, considering the two states we live in, we have a lot of polarization as far as team red, team blue.
Yep.
I'm team purple. And people are like, oh, economy's going to go to hell. This and that's going to happen if this person's elected. Here you go, folks. This is all you need to know. If you only invested in a Republican president since 1949, you didn't make much money. If you only invested with a Democrat, you did okay. But guess what? If you just swallowed your opinion on what's going to happen with the market, you made a lot of money over the years. Even if you just put it in 30 years ago, you did pretty good. So a lot of people get a little nutty with this. And I know there's a lot of information up here, but you could just see on the far right side, really what happened the year following the election. If you notice, there's a lot of double digit years there.
Yeah.
A lot of double digit and only a few negative years.
Yeah.
And you know what? If you take a look at what happened during those negative years, coming out of war, coming out of a black swan event, whatever the case may have been, but what it comes down to is stay invested. Usually it's year number 2 of a presidential election that is the worst performing of the 4 years. But for the next 15 months, 14 months, stay invested. What are your thoughts here? Because I got some more good stuff on this.
Yeah. And we covered this last week too, in the episode last week. It's if you look at that year following and really about 18 months out from the election, we typically see, and it's typically when we're coming out of one party and you go into a new party coming in, there's typically you see a pretty good run up out, and there's better performance if an incumbent doesn't win. I think we're in good shape. We've got a White House, we've got a Senate, and we've got
Not yet. Not confirmed
House.
yet.
Nope, House was called this morning. So that
Oh, it was?
218. So it's trifecta. Yeah. So they're just now at 218, possibly could go up a little bit. But the benefit to all of us is the biggest thing that they're all focused on is making sure that we reform taxes. Hopefully there's even more help from the tax perspective there. That I think the biggest thing that'll come out of this is a lot of deregulation. If you look at Trump 1, there was a lot of deregulation, and that's the biggest thing for small business.
I'll tell you what, I'm going to actually go forward and come back. That's a great segue because actually the market does not perform as well many times when one administration
Yeah.
controls all three.
Yeah.
And I wanted to bring this up because just looking at 5 periods,
Mm,
you can see where the S&P was during that time frame. But look at the times when, one administration controlled all three. Information technology and the most boring sector out of all of them,
mm,
utilities, I find it to be interesting. I'm not an energy guy. I don't like things that are pegged to oil, but you
mm.
know what? Energy has done pretty good with administrations that control all three branches. Again, looking out, where do you want to go? Where do you want to put your money? Stay invested, and you don't want to trade.
Yeah.
Yeah.
Yeah. Once again, we've seen that year in and year out. The trading is just never. Yeah. I rebalance every month. So some might say I trade, but I just rebalance based on a model that I have. But yeah, I'm not moving around a lot. It just doesn't work. You end up getting whipsawed every time when it comes to that stuff.
So if you're thinking, okay, great, market historically has been up the year following a presidential election,
Mm,
where should you put it? Oh, let's go for the growth, right? But actually, history has proven value.
mhm.
Value is where you want to put your money. And here it is 1 month, 2 month, 3 month, all the way to 6 months. Value has beaten growth historically over time, and not by 0.5% or 1%, by
Yeah,
3.5%.
by
So
significant.
again, nice slow growth is the way to go. 30% angle, not
Mm,
not 80,
yeah.
30.
Yeah,
That's where you want
because
to be.
80
And growth
turns
is this.
into 80 the other direction and then 80 the other direction. And yeah, I
Look at
think,
our S&P chart right now, it looks like that.
yeah. And I look at value. It's funny that people get oh, well, value just doesn't work. It's underperforming. I'm looking for steady, stable consistency. And when I pretty much can count on a dividend coming in, if I've got something that's averaging 6, 7% dividends, to get my 10% average in the S&P 500, I only have to have 3% extra growth in those cases. Looking for things that have got really solid, stable, consistent, even growing dividends, even if those are only at around 5%, it's pretty easy to get that extra 5% growth over time.
100%. So these are a couple of things to consider. And then the other thing, that's the positive. The interesting thing is, folks, guess what? We have economic cycles. What
Mm,
we've seen in the last 15 years is not normal with economic cycles. And where I'm going with this is that we showed a chart on this earlier in a podcast about a month and a half ago. I thought it was interesting and I wanted to bring it up again and add another one that the business bankruptcies are spiking.
mm,
And if you just take a look at where we've been historically with a lot of this, we'll see where the year ends up. Not great.
mm.
Not great. I don't know if you saw it, but there has been more restaurant chains, smaller, but more restaurant chains and a couple of furniture chains that just closed the doors in the
Yeah.
last week. Look, those are two difficult businesses, right? Furniture is
Mhm.
not a residual business, and the restaurant business is an SOB to run and make successful and be sustainable. So I'm not sure what you're seeing on your side.
You know what? So I always say that there's the Jeff gut cycle. I just look at anecdotal things, but one of the anecdotal things that my wife and I have gotten into is we're big fans of Guy Fieri's Diners, Drive-ins, and Dives. And it's amazing how over the last, I would say 2 to 3 years. So not pandemic time period, but after pandemic, watching how many of those businesses that were on diners, drive-ins, and dives that have closed since. So we
Oh,
watch a lot of the old episodes, and amazingly how many and they get this massive boost
of
of people
course.
wanting to go there and stuff like that, and how many of them have closed.
Yeah, but Jeff, they're not chains, they're small
They're
mom and
small business.
pops.
But that's what I'm saying is that tells you how hard it is for small businesses at this point,
Yeah,
to get by. And I think a lot of it's just you've got stupid, silly regulations from the government. It's just a tough economy. And I see it's funny. We have a chain called Chewy's here in
yeah.
our area, and Chewy's, if we got there Yeah, if we get there on a Saturday at, let's say, right at 11 o'clock when they open, within 15 to 20 minutes, that restaurant is packed. And I can't tell you how many times locally we've noticed that you get there and by the time we're leaving at, let's say, 11:45 or noon, the restaurant's half full. And it's one of the most popular restaurants in town. So
How
that's
about that?
telling me that people are stretched, and especially coming into the end of the year, it's Christmas time.
Yeah.
People are looking at, hey, whatever I could do to save money so I have money for my kids for Christmas.
Hey, credit card carryover debt just hit 1.2 trillion
Yeah.
and the average is now over 22%. Let's see what happens through these holidays. All right.
Well,
What do
all
you
right.
got?
Let me share my screen here a little bit. And I wanted to go through a few things that I've been looking at here lately. All right, share. Booyah. Okay, so first of which, I've had some conversations with clients regarding gold, and gold's done great. We need to stay in gold. This, I think, is not the time to start to look at gold and say, hey, we want to invest in it because after the election, and this is literally the day of the election right here. Actually, it's October 30th. We saw really the peak in gold, and it has been down ever since and has broken that down trend a little bit. And I think it's going to struggle a little bit. And the reason is a lot of people, I believe, were plowing money into gold. Of course, the world was going to end if Kamala Harris got
The fear
reelected,
trade.
got elected. It's a fear trade. Ron and I were talking about this before the show. Now there's not the fear trade. The stock market's going up. Now everybody's selling out of gold and jumping someplace else. Do I believe that there's a possibility that there's a place to be for gold down the road and in a portfolio? Yes. Do I feel like right now it is? Probably not. One of the things that I would say, hopefully, and we'll see this as we go through some of this.
Before you do that, just to let you know, the other thing about gold, I am not a gold bug. I do not recommend gold. It doesn't pay a dividend.
No,
So
no,
if you're a retiree and you're trying to squeeze the juice out of the orange with income, how
this
is
ain't the
gold part
place.
of that portfolio?
Yeah. Yeah, this ain't the place for it. And it's a speculative trade. People don't think it's that, but it's a speculative trade. And if you look at the long-term history of it, really the last 12 years, gold has gone up above its long-term trend, and its long-term trend from 2010 back to 19, I think it's 32 or 31, its long-term trend appreciated less than the price of a man's suit.
Right. And don't forget,
Right.
from 2012 to 2022, it went nowhere but down.
Yeah. Yeah. So,
You bought in 2012, you were even in 2022.
yeah, exactly. Once again, it's might be a diversifier in a portfolio. I would not be looking at it right now, and it's going to be out there. So, why typically people will talk about in the case of inflation, that's when yields, when gold goes up and the dollar's devaluing and blah, 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 blah. Let's take a look a little bit here. We've had interest rate cuts here in the very recent history, long awaited 50 basis points, 25 basis points last week. Let's look at the 2 to 10-year treasury minus the 2-year treasury. It's not really gone down in the last couple of
But it is
couple of
positive
months here.
now.
It is positive, but it's sitting here flat. Let's look at the yield curve, which is literally looks like a roller coaster at this point. Our 1 month is up here at 4.7. Our 3 years down here at 4.25. The 10 years back finally up to 445, but it's been rising. The 20 year is up here around 470 and the 30 years below that. So it's just all over the fence right now and it's changing on a weird basis. How is that affecting the things that are derived on that? 30-year fixed is popping back up. Even with interest rate cuts, we've now seen the 30-year fixed mortgage pop
Yep.
back up and is continuing to rise, which has a trickle down effect onto housing, which then has a trickle down effect onto things like Home Depots and Lowe's and all the pin action that happens as a result of house sales. And it's forcing people, and or it's not forcing, it's just making people go, I don't want to move at this point. If I've got a lower mortgage, I'm not going to move someplace else. And more than likely, those people already did a lot of their renovations and things like that over the last several years. So, how is that going to affect things down the road? Now, my personal feeling on a lot of this is that we're coming to roost on a lot of our, and this is both Republicans and Democrat administrations, we're coming to roost on our just keep building up debt. And what's happening is those that buy our debt are demanding higher interest rates as a result of it. And I don't really see that going down unless we put the government on a diet. What's your thoughts, Ron?
I got to tell you, that curve is an anomaly.
Yeah.
That is not a normal curve. It's
Nope.
either U-shaped or N-shaped. That's
Mhm.
typically the way it is. I was never a bond guy before 2 years ago, and when you're looking at this, if you're trying to consult with a client on protection or, security or whatever, no who's going out to 20 to 30 years?
Mhm.
Nobody's really doing that. But then again, you don't have to hold on to it that long, but not many people are doing 1 and 2 month. We haven't done any new treasuries in a month and a half, right?
Yeah.
We're not planning to do anymore because we could do better in preferred stock. But look
Mhm.
at the 2 and the 3 year. That's a
Yeah.
nice short term. You're getting significantly less than law. So my whole point is that I don't know how an average investor would want to put money into any of this when there's better yield, better performance elsewhere.
Yeah.
This is for banks, this is for institutions, but it
Sure.
does affect us eventually.
It does. And once again, I just don't see these things fixing themselves anytime soon. Okay, yeah, I could put my money out here and do a weird short-term ladder that goes out basically 4 to 6 months, but the average yield is not there. So I agree with you. I think there's better yields now and have been for a little bit now. There's better yields on the preferred stocks, better yields even in inside dividend paying stocks. There's way better yields right
Look,
now. And you still have a little bit of a potential of growth too within
yeah,
there.
preferred stock is probably one of our largest asset classes right now across all our clients.
Yep.
First of all, you could easily get 5.5% dividend
Yep.
yield fixed,
Mhm.
and you're buying them at a 15 to a 25% discount.
Sure.
And many of them have a redeemable date in the next year or two.
Mhm.
So unless you think like the big banks are going to go under,
Mhm.
you're going to get 15 to 25% on one side and 5.5% on the other.
Sure.
Why would I go into any treasury right now other than knowing, okay, it's backed by the US government? So are the top banks.
Yeah. Exactly. Yeah, totally agree with you. I think it's an interesting time. I think it's going to be an interesting next couple years here in the markets. I don't know when the yield curve kind of stabilizes itself to something normal because normally it just looks like a nice little uphill. It makes sense. The longer out I put my money, the more interest I get paid, and it has not been for a long time. And it's really been interesting. The 20-year has popped up, whereas the 30-year hasn't moved. Which that's been weird over the last couple years here, where it just keeps doing that and that. It doesn't make sense that the 30-year
Yeah.
is it's below
My
it.
my last point to that, what's going to fix the curve? So I am far from an expert in it, but I do follow it. I do listen to some smart people about it. I think the one of the biggest factors, if not the biggest factor to it, is our debt.
Yeah.
I don't know
Yeah.
if we're at, but I know we're near 36 trillion. And I
Mhm.
think that's a combination of risk and return and true like risk and fear.
Yep.
And I think that is made the entire yield curve wonky as far as where banks and institutions want to try and fix themselves, or as far as I'm sorry, not fix themselves, but at least protect themselves on the risk curve for them as best as possible. How they're
Mhm.
doing it, I have no idea, but I think that's why the risk curve is as wonky as it is because of our debt. And we keep issuing more debt. I haven't heard either side talk about less spending and
Yep.
or increasing taxes to cut that in half.
Yeah.
Because of that 36 trillion, and I promise this is the end of the rant, more than half of that was created in the last 5 years.
Yeah. Yeah. It was COVID hit, and it was this government going, we want to keep everybody happy. So we're just going to keep piling money into everything. And once again, I've said this all along, it's Republicans and Democrats. It is not one
Both.
party or the other. It's
No,
they always are trying to figure out ways to keep the people voting for them by dumping money down their throats. And it's
they got to
one
get
version or
reelected.
the other of it. And nobody's really sitting there saying, all right, it's time to fix the problems. Who knows? We've got the Doge department coming up, which I think is very funny with Elon Musk, him and his Doge thing. There's always something Doge related to
Yeah.
all that, but we'll see. I think there is it sounds good to say we're going to make government smaller, but it's a big old challenge that there's a
Yes.
lot of resistance there from a
Yeah.
lot of government
They could
employees.
easily reduce government
Yeah.
10, but probably closer to 15 to 20%. With today's technology and everything, we don't need as many people.
The thing is, there's been no incentive to do that. And until you incentivize somebody, and I don't know how
Well, it's been
incentivize
artificially propping up the employment rate.
very much. And that has been it's interesting that 12,000 jobs was virtually that we saw a couple weeks ago
It's
was
all
virtually
government.
all 100% government jobs and nothing in the private sector. So I think it's going to be an interesting world here over the next couple years. I would foresee a lot of really crazy battles between government organizations and the bureaucracy and the administration and Congress and everything else. So it's going to be an interesting. We'll grab your popcorn because I think it's gonna be
More conversation for next week.
exactly. Folks, thank you for joining us. We do these shows for you. Make sure that you subscribe to the channel. Make sure that you give us an upvote. Love the comments. There's been a lot of great comments lately that I've been interacting with people on. So love to do that. Love to answer questions on that. And that also helps us figure out what you're interested in so that we can build shows around that. So thanks a lot. And we will see you guys back here the next time.